To play on your words, I mean, a bit of small change saving every now and then becomes big change later. And so I think let's talk about how we do that, on the, again, more nuts and bolts. So if I want to save fees as an investor, I think one of the big themes, and it's mine, this is, the kind of honest money show, and one of our drum beats that we like to beat all the time is, look at the way that you can invest and to save fees is, index investing. And so what is index investing? I'll give a bit of a brief there, because I'm going to give you a bit of a harder question now. So I don't want to give you all the easy questions. So just as a reminder for people that are watching and listening, index investing is where you say, for example, in South Africa, we want to track how the top 40 or top 50 biggest companies in South Africa, how they're performing, how can I buy them, and how can I do it in the cheapest way possible. And one of the ways to do this is that you buy a thing called an index, which is created. It's something that's managed and monitored all the time, not by fund managers, but by index creators. And these are people that don't have a vested interest in choosing particular shares. All they want to do is replicate exactly what the stock market has done. So, for example, if Anglo American has a really good 3-month period, and it goes from being the 3rd biggest company on the stock exchange to the 2nd biggest company on the stock exchange, and you own an index, what will happen is over time, Anglo American will become your 2nd biggest share as well, because all that's happening is the index tracker, as a provider of the investment, is trying to replicate what's going on in the index. And so the logic of buying index investments over time is that it's very hard for fund managers. So where you pay a fund manager to try and choose the shares that do better than the index, what history shows is, not just in South Africa, but right around the world, it's about 2 out of 10. 2 out of 10 fund managers get it right to beat the index over long periods of time. And in some cases, it's only 1 out of 10. And my problem is, as someone who's trying to recommend investments all the time, is it's not the same fund manager who gets that right every year or every decade. And so yes, they do get outperformance, and the ones that get it right do achieve big outperformance. The problem is we can't get consistent in terms of choosing those fund managers at the start of their investment kind of track record. We only know it once they've done it, and history can tell us what they've achieved. So the reality is, if you want to control costs, like Grant says, then one of the big ways to do that is to say, okay, let me buy an index, because then you've got certainty that you're going to replicate whatever the index has done. Yes, you don't control how the index is going to grow. It might double, it might halve, but you are going to get that performance, and you're going to get it at a very low fee. So from that perspective, I think it's a great outcome for investors. That's not to say that you shouldn't look at active managers who try and beat the index as well. I think we shouldn't be so binary in our investment world, where we say there is only one way for everybody. There will be people that will achieve outperformance, and that's good for them, but understand the risks and make sure that you're paying the right fees. But if we're talking about index investing and trying to make things easy and accessible for investors, then I think index tracking is a good way to start. And then we need to understand that there are really, I think, 2 main ways that private investors can buy an index. The one is what we call an exchange traded fund. The kind of shortening of the abbreviation for that is ETF. And the other way is that you can access index tracking investments via a unit trust.